25,167. TCS, maybe we just give it a quick look. How's the pre-open left off at? TCS is down about 1/3% as well. Mitesh is with us. I don't know if you've got 30 seconds to squeeze in. Okay, I think we don't have time. So we'll just hit market open now straight and look at where some of this is coming through. The rupee is opened at 88.79, 88.78. So there is so far no reaction to all that, to the phone call and the promise of staying in close touch between Prime Minister Modi and President Trump. We're starting off. What do we have? It's a very, very quiet start this Friday morning. 25,176. Nifty Bank is up about 1/3%. Okay, it's up. It's just sort of opening flattish as well. So 56,250 or so. Mid-cap index is up about 60 points. That's again flat. The small-cap index will come up as well. And I don't think there's very much there at this point in time. You got some life insurance companies which are perking up again. Numbers, as Yash was pointing out earlier, from Max Life and SBI Life are strong. So, those are the two names. Otherwise, we're just sort of starting up with lots of individual counters. Nifty heat map will give you a quick sense of where we start, and then we'll get into individual stocks. It's mixed. So more down than up. Yeah, absolutely. 35 odd lower, and the rest are higher. SBI Life on one end, Mahindra is on the other. Rima.
Well, IT is seeing some profit booking. The Nifty IT index opens with a cut of about 0.5%, with TCS also seeing profit booking down 1%. This is after a 5.5% rally over the last 4 days. So TCS is retreating a bit. Tata Elxsi too seeing profit booking down 2.8%. Remember, numbers are not bad, but in the case of TCS, we'll have to see how all their plans to play the AI ecosystem materialize over the next 5 to 7 years. As of now, it's not going to change the growth picture or the revenue numbers. The Q2 was not as bad as perhaps what the street would have feared. So TCS and Tata Elxsi seeing some correction. Along with that, throw in a Tech Mahindra and HCL Tech. These stocks too have opened in the red. Infosys too down close to about 0.25%. Avenue Supermarts should also come up for you on your screen. They will be declaring their numbers later today. We already have the Q1 update. It had disappointed the street to some extent, right? Avenue was a bit disappointed in the Q1 update. Yeah,
yes, it was.
And the stock has opened up on the flatter side. Maruti Suzuki, Nestle, Shriram Finance, HUL, Titan, ICICI Bank. These are some stocks which are seeing some mild cuts early in the morning. On the way up, SBI Life is the big winner. That's up nearly 1%. The new business premium is up 32%. HDFC Bank, Kotak Mahindra Bank. In fact, some of the private sector banks are trying to pull the markets. At least the Nifty Bank, it's holding up in the green. And Reliance Industries declares their numbers next Friday, 17th, post-market hours. So that's the date to mark on your calendars, and Reliance Industries is open in the green.
Yep, that is the one that we're looking at. But from the broader market, it's slightly better than what the frontline end would suggest. Today we have straight off the gate 1,300 stocks which are in the green, and this compares with just about 900 stocks which are in the red. Those who applied to the LG IPO, looks like they're also excited about the other consumer durables. So the top 3 gainers in the F&O space today belong to the consumer durables. You have Blue Star, which is up 3%. Whirlpool is the other one, which is up to 2.5%. Voltas also is up around 2%. So a flurry of activity in that space on account of the strong demand for LG's IPO. We're also seeing some traction in Angel One, continues its up move from yesterday, ever since there was a reportage that maybe it could take some more time to take a call on the weekly options expiry. Some profit booking on metals. Yesterday, metals were fairly well bid. Hinzing opens lower. Hindustan Copper is lower. NMDC also, along with Vedanta and SAIL, are lower by about 2%. And we're seeing big gains in a name like Subex. Early in the morning, Subex is up 8%, and so is Natco Pharma, both of them with a fair amount of volumes backing them. And GM Breweries, after an 18% up move yesterday, we're seeing some profit booking. It's opened about 5% lower.
Absolutely. And, market open coming up on your screens. And maybe we should just look at a few names here, right? I mean, let's just look at Ixigo there as, post the open that we had. So Ixigo, I think, is up about 1% or so. So that's 3 rupees, 316. Now, I think we already looked at all the IT stocks, and maybe just revisit the Nifty IT index per se. And if there's something coming up there. Metals were a big winner, winning sector. JSW, Tata Steel, etc. And the Nifty Metal Index was up 2% yesterday. So starting about 1% lower. MCX was a big winner yesterday. We should just look at that as well. Look at BSE. These are all, 1% on MCX. BSE was up about 3.5%. It's up another 3% right now. And it's got volumes almost nearing about 1 million shares now. And I think we mentioned Angel Motilal Oswal was up sharply yesterday. We should look at that as well. Bluestone, that's the recently listed jeweler, has had 2 days of phenomenal run. And Bluestone will also come up, and we should look at that. There is a fair bit happening. It's down about 3.5%. Another one was Black Buck, right? That Zinca Logistics, which was up sharply yesterday. And, sometimes you just have some reversals after very, very sharp moves, and that's what's happening. The number one volume-led loser in trade yesterday was NetWeb. It was down by close at 330, down 10%. And let's just take a quick look at where that is starting. It's down another 1% or so. So from 44, 43, 4400, very quickly it's come down to about 3900, but it's had a one-way kind of a move so far. Vikas Khewani is with us. He's a market master of the day, founder at Carlinian Asset Management and advisors. Vikas, great to have you with us here. Thank you very much. This US-India bit, I was just, the way I was framing it was one step closer, looks like. Or maybe the equity market is already starting to pick some of this up. FI selling has, stopped a small buying here and there. And you've got, Prime Minister Modi, President Trump speaking last evening, Treasury Secretary in the US saying, India is going to buy more US oil rather than Russian oil. What's your sense, Vikas? The question really is that meaningful for markets whenever that gets resolved? And in what way?
Hi, Prashant. Good morning. I think, U.S. tariff uncertainty has been long talked about, and I think we all know that it is not very significant from an economic impact perspective. But having said that, you do not want any disruption in the U.S.-India trade relationship because both economies are very, very important to each other. And I think there is a wide, large, major conviction within the market participants in general that in due course of the time it will be sorted out. I don't think the continuation of 50% tariff is going to go for long, and I think it's good that we are making strides in that direction. But throughout this uncertainty of last 4 or 5 months, we have continuously said that what RBI governor is doing is far more important than what Trump is doing, in the sense that if you see our regulator has taken far more growth-oriented policies, right from cutting the repo rate to infusing liquidity in the system to last week's policy of where the huge reforms happened or the relaxation happened to boost the credit growth. So all those things are far more important. And if you see from government side, whether it was income tax cut, GST cut, spending on the infrastructure, everything is going well. So when your government as well as the regulator are clearly taking a lot of growth oriented policies, it is only a matter of time that it will reflect. We've been kind of quite positive on the entire corporate earnings cycle. We've said that in next sort of second half of this year, you will see good corporate earning picking up. Now, so you have a good setup going on right now. As the clarity comes around, whether it is corporate earnings or tariff-related issues or anything else, I think market will keep inching up towards, as the uncertainty settles down. That's been our broad sort of approach towards the market. Regarding your questions on FI selling, I think I've long said that it has nothing to do with the trade deal or this and that. I think, India is a part of emerging market basket. Whenever Fed raises interest rates, the investors in US and elsewhere pull out money from the emerging markets. And that was happening since post-COVID when the Fed started raising rates. As far as and in that period, India was significantly overweight because China was not doing well. And in 24 and early part of 25, as the China weight started going up, obviously India became whatever, you have to sort of sell India to get the China weight. So now as the Fed rates are coming down, beginning of that has happened. I do believe that we will start seeing a significant flow coming through from FIs as well. So I see good liquidity happening. I see good corporate earning happening. And as some of these talked about uncertainty settles down, you will see market holding on that.
Yesterday, one of our experts, Vikas, said that, tariffs are temporary, but the GST cuts, the RBI policy, that's permanent. So just echoing what you're saying. But are you comfortable buying India's new age platform companies? Because as you have been talking about to your investors in your letters, that the fad FOMO phase seems to be over, and companies are now cognizant that they need to focus on the profitability, the fundamentals, rather than just chasing growth. So the question is that, this narrative is now playing out, profitability over just, crazy growth, frenzied growth. But are valuations comfortable to buy, say, a basket of new age platform companies now?
Very good question. See, if you see when they hit the market in 2021, I think they were largely driven by the, very big, fad. I think more they burnt money, more probably valuation they got from the market, and most people, and I think it was yet to be proven how they will scale up and all those things. But in the last 3-4 years, that burning to earning kind of change has happened. Most platforms are focusing on sort of reducing the burn and get to the operating leverage and, build a sustainable model. And I think that is what markets like now. There's no denial on the fact that, platforms are good play. And we've always said that we never had earlier companies with the platforms play, and neither now. I think because they have a high operating leverage, it requires a lot of effort to build those platforms, and they are serving a specific need of their segment, whether it is Paytm to any platform you look at, right? So I think they bring lots of operating leverage and scalability without so I think that you will see. So we like the whole space, and when I'm saying whole space does not mean we like all the companies within that space. We don't kind of understand many of them. So as long as we understand that there's a moat behind the platform, there's less risk of disruption, competition is less, and platforms can scale up from here in next 5-10 years. Those are the platforms to bet, and you can't, value them in the conventional valuation methodology. So, and there's no right or wrong sort of number for that. So you try and understand, what could be the operating leverage, what could be the outcomes in next 4 or 5 years, and then try to understand from that perspective.
Right. From here on, if you had to bet on one particular theme over the next 12 to 18 months, which one would that be? And on the other side, what's a place that you would not want to put your money in?
I think given the fact that, RBI gave significant relaxation on the credit growth, I do believe that credit growth will pick up significantly or in a meaningful manner. So you will see banks doing pretty well. Again, investment cycle has that it continues to remain robust. So look at, companies like L&T and Allied Pack, which has kind of done well. And those are the businesses which, in my opinion, are still significantly sort of undervalued. Consumer seems to be, especially in the discretionary side, there is a good, demand happening. And, with the interest rates coming down and tax rate cut happening, it also acts as a demand booster. So I think these are the 2-3 packs which will do well. And having said that, of course, you have to identify right company which can benefit from that. But generally, broadly speaking, these are the 3 broad segments will do well.
And what would you avoid?
Avoid, I think, generally speaking, see, at most, I would avoid hype stock. I would avoid where there's no risk reward, one understands. So, that's a general thing, but I'm not like per se negative. And if there's such a widespread growth happening, you would not want to sort of, call out negative on any segment. But within each segment, when broad-based growth is there, within each segment, there are hypes which gets created, and one should definitely avoid. I'm also not as sold as on consumer staples because they are significantly high. They're better risk reward trades, not because, they are not good companies, but they're better risk reward investment elsewhere, given their valuations and growth profile.
Vikas, yesterday, not talking stocks or anything, but in terms of business line, TCS said they're going to invest in a data center, 1 gigawatt over 5 to 7 years. Could be $7-8 billion in investment. Not about TCS, but about that line of business. Have you looked at it? And where is the value? There is there is a lot of stuff which goes into it, right? There's racks and servers and power lines and chillers and cooling and concrete. Where is value? What should one look at? Which area?
See, there's no denial that data center is a very big opportunity in next, 1 decade or so. And I'm sure lots of capacity will come. So I think our view has been that direct players are very limited, and like similar point that because it is sought after segment, I think valuations are, or you don't understand how they are kind of being considered. So I think, enabling sectors, there are many, and it's not only with respect to data center, but, whether it is cables, whether it is, I think there are lots of, enabling segments which can play with that, but they will not be pure play data center play. There will be allied plays as well, because what you supply to data center, all those companies also do work with many other companies as well. So I think somewhere, this also acts as additional growth for the company operating those enabling space.
Because broadly, if we see more IT companies making a play on the AI ecosystem, even though there is no direct synergy. So for instance, just for the sake of an example, TCS making that investment in AI data center. So there is no synergy which comes from an IT services companies. But we've also been complaining on the other hand that these companies cash rich and they've been making unproductive. The deployment of capital has been unproductive. So if we see more companies making such bets, should investors cheer that, or would you be skeptical because it will alter the free cash flow, the returns, the ROCE will be lower than the existing business?
I'm sure, see, they are going to make this over a long period of time. So it's not that they're making $7 billion investment in a year, but given their cash flows, I think some kind of, is fine. And it's not completely unrelated. Of course, it is, different business, but it's not completely unrelated. Maybe there are certain synergies also they see. So I would look at, according in that direction. But I think as far as the IT sector is concerned, I think all companies have to get ready for, AI related technologies because as the demand is shifting on the direction and companies which do enable or get ready faster will be the future winners. But yes, like every time there's a technology transition happens, not necessarily yesteryears companies do well in the future. For example, if you see, Y2K time, Infosys, Wipro, Satyam were the, sort of winners. After 2009, when digitization, cloud migration, the theme came, HCL Tech, Persistent, LTTI, LTTS, Mindtree, all those companies kind of scaled up very well significantly, some of them even 20, 30, 40x. So I'm quite sure that this cycle as well, you will find new companies which will become very, very large future winner, which are today might be small. In the real opportunity, if you ask me, in IT space lies in those small spaces, segments where you can see companies becoming 20, 40, 50x.
All right, Vikas, always a pleasure speaking with you. Thank you so much for giving your insights and wish you happy festivities. Obviously, we will speak to you more as we move towards the festival end of the year. The market's picked some pace. In fact, it opened flat. And now look at the Nifty. It's been led by the Nifty Bank. The Nifty Bank is up around 0.5%. Yesterday, it was the IT pack that did well. The Nifty Bank was a bit of an underperformer. Today, the IT pack is seeing some profit booking and the Nifty Bank is, taking the index higher, 56,500, close to that level on the Nifty Bank, and the Nifty closer to 25,250. So it's high on the Nifty that we've seen over the last week or so. It's much stronger than that. A lot of broader market names doing well too. Inox Wind, for one, has moved higher, and alongside that, Tata Communications is the other one which has recovered a fair bit. In fact, this week itself, Tatacom is up around 9%. Natco Pharma is the other one which was buzzing around. We have Vinny joining in to tell us what exactly is the story here. Vinny.
Hi, good morning. So an important judgment that has actually come in favor of Natco Pharma. This judgment is coming from the Delhi High Court. So the Delhi High Court has now dismissed Roche's appeal against Natco Pharma. This is for one of the drugs which was going to be launched by the company that was for spinal muscular atrophy drug, which is used for this treatment. Now, obviously, the company will get to launch this product now coming in because the court has dismissed the appeal for which was against the which was put in by the Swiss pharma company. This will clear the proceedings for the launch of the generic version of this drug, and this will be launched at a price of around 15,900 rupees. And like I mentioned, used for spinal muscular atrophy, important drug and important for patients' point of view as well. So keep an eye on Natco Pharma today. It's surely buzzing away in trade on the back of this.
Thank you very much for that. And now let's head across to Ria for more on Sona BLW, Lloyd's Engineering. Ria?
Well, yes, Sona BLW has been in focus today after the company has entered into an MOU with Neura Products. Now, this is for the joint development of advanced technologies, components and sub-assemblies, as well as for the industrialization of robots and humanoids. And this will be done for Indian markets as well as other markets which have not been specified. Lloyd's Engineering has also been in focus after entering into an MOU with Flyfocus. Now, this is being done to jointly develop and manufacture the Defender Signals Intelligence UAV. And as part of this MOU, they will be ensuring complete localization and a technology transfer, as well as the eventual indigenous production of this Defender UAV. Now, the collaboration also provides exclusive rights to Lloyd's Engineering for Indian deployment, as well as adaptation of the Defender UAV, and it also opens up export potential for the company, which is why both of these stocks have been trading higher today.
Right, Riya, thanks a lot for that. So those are a couple of stocks that are buzzing around. Let's get in another corporate conversation. After the recent GST rate cut on commercial vehicles, is demand beginning to turn the corner? Early data shows a mixed trend, with Vahan numbers indicating a 9% drop in heavy vehicle registrations, but a sharp 21% rise in LCVs this festive season. The bus segment, however, continues to lag, with steep double-digit declines across categories. Meanwhile, VECV is getting up for its next big milestone, which is a 550 crore investment to set up a new facility in Ujjain, a key part of its India and Asia-Oceania strategy. Joining us now to decode the market trends, the outlook for the bus segment, and more importantly, the next phase of investment, is Vinod Agarwal, the MD and CEO of Volvo Eicher Commercial Vehicles, VECV as we know it. Thanks a lot, Mr. Agarwal, for joining in, and festive greetings to you. The GST rate cuts, that's the first question. Has that improved demand or has that impacted demand? Because the data that we have right now is fairly mixed. What's your sense?
Of course, the data as of now doesn't show that the demand has gone up. However, I think GST cut is a very, very big step from Government of India. As we know that this had been our very, very long-standing demand with the government, that reduced GST from 28% to 18%. And now government having done its job, it's back in the industry's court that we have to deliver more. And the other thing is that it has created very positive sentiments with the consumers and the businesses or the consumption. That is driven a lot by the sentiments. When the sentiments have become positive, we are expecting very, very bullish festive season, and there is going to be good sales for the white goods, fast-moving consumer goods, and e-commerce. As it is, we can see that rush in the malls if you go to the market. Therefore, I think we are very positive, because if the economy does well, if the demand for all the goods increase, demand for two-wheelers increase, or demand for cars increase, I think it reflects in the movement of more goods and services. Therefore, we have no doubt that it is going to be very positive for the industry, and commercial vehicle industry eventually will start growing.
Mr. Agarwal, morning. Rima here. The bus segment is under pressure. Can you explain the reason for that? Is it on account of the urban EV push, or is it something else? And when do you expect a recovery?
I think we should not say that it is under pressure, because if you look at the bus industry sales, last year it had touched 96,000 total for the year. Now we are comparing with that peak sales of 96,000, which was the bumper growth. And this bumper growth was happening over a period of previous 3-4 years also. So the earlier peak of 18-19 for buses was only 60,000, 60 to 96. And this year, first 6 months, we have seen that in September there was some drop. But of course, the first 6 months, bus industry also has grown by 4.5%. So I will not say that it is under pressure or it is going to be a drop. There are always some technical corrections when some segment grows very fast and reaches a very high levels. You can't expect that on those high bases, the industry will continue to grow with the same rates. So therefore, I am not worried at all that bus industry is doing well, and it will continue to do well. From December onwards, we will see the school season starting, staffing requirement also, the buses for staff movements. That also is very, very positive. So therefore, I have no doubt that the buses industry will continue to be good.
For full year bus sales, what do you anticipate for FY26?
Last year it was 96,000, and
Yes.
first 6 months it has grown by
4.5%.
5%.
No, for the full year, what do you anticipate now? What
Therefore,
will the number?
even if you assume the growth will be around 4-5%, You can easily say that it should be around 100,000.
All right. And you were fairly optimistic on the commercial vehicle segment as well. Light commercial vehicles doing extremely well, heavy commercial vehicles not so much. For the remainder of this year, and as a result of which for the full year, what's the kind of guidance that you can give? Can you put some numbers to the optimism that you have?
So if you look at the numbers, wholesale numbers, sometimes retail there is a lag in retail numbers.
Yes.
Like if you're looking at Vahan data for September, obviously the GST impact has not come in the Vahan data. So if you look at the wholesale numbers, the smaller commercial vehicles as well as the light and medium duty trucks, the growth in September has been very good. And it's only the heavy duty trucks where the growth was there, but it was not very high growth. And for first 6 months, heavy duty trucks have, in fact, wholesale numbers also have dropped by around 1.4%. So therefore, heavy duty trucks have dropped in first 6 months, whereas the light and medium duty and the sub 3.5 ton small commercial vehicles. In fact, in the month of September, small commercial vehicles have grown by 16-17%. So therefore, the GST impact has been seen in the small commercial vehicles and also you can say in the light and medium duty trucks, but still we have not seen in the heavy duty trucks, because heavy duty trucks, 50% of the customers also sometimes they don't take the they don't get the immediate benefit, because they take the GST credit, they take the input credit. So even if the rate was 28%, they were taking the credit for the GST paid, and they were getting the refund through the GST.
No, we get that point, and we have the numbers for the first 6 months. Now, the question is the next 6 months. How much faster than the first 6 months would you see growth in the next 6 months?
Look, if you look at the past trends, second half is around 55% of the full year, and the first half is 45%. So if you take that same logic, the second half is going to be much better than the first half, because numbers are always more than the first half. First of all, it is the festive season impact and then the last quarter impact. Therefore, we are expecting good growth coming in the first half. There is a growth of in the 3.5 ton and above, around 4.5% total industry, 3.5 ton and above. Second half, we are expecting more than 4.5%, because there will be impact of GST. There will be you will feel the real impact, and of course the economy is growing. Infrastructure investments are happening. Replacements are going to be stronger. So therefore, I have no doubts that second half is going to be much better than the first half.
You've announced a 544 crore investment to set up a Volvo 12-speed AMT facility in Ujjain. What is the commissioning timeline? What do you expect out of this? How does this strengthen your India, Asia, Oceania strategy?
First of all, it is a very, very prestigious project. When Volvo Group reposes more trust in VCV, that they have given their state-of-the-art and very high-end transmission, automated manual transmission to manufacture in India. It's a very big thing for India, that we are going to manufacture in India for the world. We are going to meet the Volvo Group's needs for Asia, Oceania markets. Therefore, I would say it's a very, very big step, very positive step. And of course, the commissioning time for this project will be around 2 years. We are expecting that we should start manufacturing sometime from October 2027.
Right. And what about exports? What proportion of your sales now in the second half will come from exports? What is the kind of growth projection that you have? On a low base, it's been growing faster.
Yeah, exports are now the market. Markets have bottomed out. We are seeing good traction in all the markets now. If you look at first half, the industry exports out of the country has grown by 33%, and we have grown by 40%. We are doing better than the overall market, and we are expecting that the second half will continue to be strong. Last year, full year, we exported 5,000 plus vehicles. So first half we have grown by 40%. So let's hope that the growth continues like this.
And you don't worry about competition in the export markets because of US tariffs, etc., right? Those who could earlier give to the US will now, perhaps because of higher tariffs there,
Don't go
look
to
at
US.
flooding other markets.
Trucks and buses don't go to US.
No, not yours, but your competitors who would be selling it to the US will now perhaps be looking at other markets.
No. From India, no truck or bus goes to US.
All right, take that point. Thank you so much, sir, for joining in and giving us an outlook on the festive season as well as the second half of this year. You believe the second half definitely going to be a lot better than the first half. We will look forward to those numbers as well. With that, we'll take a short break, come back on the other side, our quarterly special, Quarter Se Quarter Tak, on our show. And this time around, we are discussing, with Nischint Chawate, the segment...
Insurance segment, we'll discuss what to expect from the insurance sector in Q1 FY26.
Welcome back. We've got the market, which is up 100 points now, and it's started absolutely flat, absolutely slow, but I think we've picked up nicely. So the market indeed is paying attention at the margin to what happened last night with regards to that phone call between President Trump and Prime Minister Modi. I mean, the momentum has been there in any case. You can add 2 and 2 together. You can perhaps try and put attributing reasons to what the market's sensing. But general sort of right direction in that sense. Insurance is what we want to focus on in our segment, Quarter Se Quarter Tak. Let's put the spotlight on what to expect with regards to the top insurance companies. Yash is standing by to give us a preview, and then we will bring in an analyst to talk about this. Yash, over to you.
Well, Prashant, it's been an eventful quarter for the life insurance companies. A new regulatory body chairman coming in. Government announced GST changes having additional cost implications for insurers, and then insurance companies passing on that cost implication to distributors to somewhere insulate their financials. Kotak Institutional Equities expects it to be a quarter of anxiety and weakness. As far as annualized premium equivalent or APE is concerned, Kotak expects Axis Max Life Insurance and HDFC Life to fare better than the peers. So for Axis Max Life Insurance and HDFC Life, it expects an APE growth of 14% and 10% respectively. For SBI Life, LIC and ICICI Prudential Life Insurance, Kotak expects APE growth to drop by 1%, 1% and 4% respectively. Now, as per Kotak Institutional Equities, VNB trend is expected to remain muted. Axis Max Life Insurance expected to deliver the highest VNB growth of about 20% in the quarter, followed by HDFC Life at 11%, followed by SBI Life at 7%. ICICI Prudential Life's VNB growth expected to remain flat, while LIC expected to see a drop of about 3% in its VNB. Now, post the GST changes and, importantly, the disallowance of ITC, that is expected to weigh on the margins. The industry, expected to see a margin drop of anywhere between 50 to 150 basis points. Valuations have remained largely stagnant. Max Financial, HDFC Life trading at about 2.2 times FY27 price to embedded value. LIC trading at about 0.6 times FY27 price to embedded value. Now, importantly, 5 things to watch out would be the impact of GST and changes on the margin. Second thing, passage of commission to distributors and absorption of the cost. Third thing, demand outlook for the second half of FY26. Next thing would be commission trends for the second half. And finally, demands which the insurance companies have placed with IRDAI chairperson with respect to release of risk capital, also spreading out of expenses because of the GST changes through the policy term of any given policy.
All right. Yash, thank you very much for that. Nischint is with us, analyst at Kotak Institutional Equities. Nischint, Yash was referring to your report, saying that it's a quarter of anxiety. So just start there, Nischint.
Yeah, so it's been a it's been a volatile 3 months, right?
Yeah.
First month was fine. August volumes were weak, given the fact that everybody was waiting for the benefit of GST exemption, and I think finally you saw some pickup in business in the month of September. On a YY basis, it appears to be less impressive, like the 9% private sector growth. But keep in mind that last year, in the same quarter, there was a lot of flash sales, before the surrender value guidelines came in. So on a 2-year CAGR basis, the industry has fared fine. We are closer to around 15%. So, well, that's not a bad outcome. And so the more important aspect is, how does demand, move from here on? Clearly, insurance prices have been lower. You've clearly seen, prices going down for term and for health, even for the other products to some extent of, whatever extent GST was there. So does that really help to stimulate demand? Does that really help you to kind of, reduce your sales effort? And I think that is going to be the positive, outcome that we are expecting to see. I think on the other side, as we said, the loss of input tax credit or ITC, how that gets shared between the distributor and the insurance company, I think that's something that we'll have to see. So those are the two things that one is really watching out for. This quarter per se, these results are less relevant. What pace of VNB growth is there in this quarter? That's less relevant. What is the outlook for these two aspects is something which is very crucial.
Absolutely. For a quick second, if I can ask you to comment on, we reported yesterday, Nischint, that post this GST cuts, etc., post the GST cuts, insurers wanted to sort of pass this on to consumers by cutting commissions, etc. Distributors like PB Fintech, etc., have pushed back, and looks like insurers have relented. There are renegotiations, etc., going on. Any way to think about this, and how important is this for a player like, I don't know if you have coverage in PB Fintech or insurers on the other side?
Yes. So I think, the one good thing that's happening is that, you've seen tariff for the customer going down. And, there is a resolve that, it remains low. So whatever is the burden that has to be shared between the manufacturer or essentially insurance company and the distributor. So I'm sure it is, there is a to and fro. It's like a game of chess, right? So you negotiate on some aspects and you find the middle path. The end of the day, what is expected is that you should see volume buoyancy. You should see more people inclined to buy insurance, and that will improve your operating leverage, and that should ideally offset, all the losses and the discussion that we are having right now. So the intention obviously is that there should actually be a more virtuous kind of an output. That's where I think that is a desirable outcome.
Got that. Fair enough. Now, let's talk about individual companies and where, for our viewers, given all the uncertainty and the road ahead, the quarter, of course, as you said, is not so important. How would you rate the companies under your coverage in terms of their ability to do well in this environment, given as things are?
So see, companies today, as I said, things are fluid, and that's why we use the word quarter of anxiety. But companies have multiple options. It's the decision that they make will determine, how things are going to play out. At the same time, there is competition between companies, and there is a distribution dynamic. So that's how I think kind of things are a little easy. Having said that, I think if you look at specific names, HDFC Life, generally a player who tends to kind of balance out margins and growth, kind of has always been more on a on a balanced side on some of these things. I think we would expect that they should have a reasonably good ability to sail through these things. We would expect some swing in margins maybe for this quarter, but margin broadly remaining in the same range and taking it up from there. I think likewise for SBI, right? SBI is generally a low-cost player, and which is the reason this whole loss of input tax credit impact should also be lower for them. And the second thing is that SBI or State Bank of India as a franchise has been weak for a while now, right? You're sitting on a fairly low base. And if one says that, look, this is going to stimulate demand, at the grassroots, then probably SBI Life should benefit a lot on the volume front as well. So these two companies should be fairly well placed. ICICI Pru Life, is again a player where you're probably seeing a base effect playing out on volumes, but the dynamics in terms of how the margins, etc., evolve is something that you'll probably have to see.
Yeah, got that. Nischint, from a overall, we got a new person at top at IRDAI as well. Another story we reported on was, this broad focus once again on sort of commissions. There was that Bima Sugam earlier. The idea, what's your sense there, Nischint? You think that's going to remain a focal point as well?
See, the point, I guess, the principle, that idea is following is that, look, there is an expense on cap on expenses. So with that, what you pay to the distributor, what you pay on yourself, I think it's completely left on to the company, and companies can make a choice. Somebody would say that I would do business mostly with banks. Somebody would say that Policybazaar is a great partner. Somebody would say that, no, I'm going to balance all these things. It's really on to you. So should distribution commissions be down? Well, the cost of doing insurance or the cost of reaching out to the customer should go down, right? One can say that I'm going to cut down commissions. One can say that, well, I will not cut down commissions, but I will cut down some other expenses. Or somebody else would say that, look, the sales process has become a lot more easier. The product has become a lot more appealing and affordable now. So even if commissions go down, it doesn't really matter, right? So that's the dynamic. So I know we keep on really talking about, X% impact on the distributor and Y% impact on margins for a company. But we'll have to see how the dynamics evolved on demand. That will be the most important driver going forward. At the same time, how do distributors react? Does it become, less viable for newer, younger breed of agents to come into the industry? Because if the commissions go down, and hence in that scenarios, how do insurance industry kind of assess out its margins and agency commissions? I think those are also the things that we'll have to see.
Yeah. Got that. Nischint, we'll leave it there. Thank you very much for joining us, and we'll, I hope, speak after numbers start to come through for an analysis of what they show us. Well, I think we want to focus on another important story, and this is relevant for the Indian automotive sector. Actually, it's important for the industrial sector here in India across the manufacturing ecosystem. China has tightened export rules for crucial rare earths once again. And the idea behind this could be with regards to, of course, its stance and its back and forth with the US, but it's got implications here in India as well. Parikshit is here with this important story. Parikshit, over to you.
Well, China had imposed the first round of export restrictions on high rare earth magnets in April this year. Those restrictions continue as it is, though there have been exceptions made, waivers made for companies and countries on a case-by-case basis. India has also been getting consignments of low rare earth magnets, but those have been through a very slow and arduous process. We're still not getting heavy rare earth magnets according to our sources in the automotive industry. Having said that, there is now a fresh notification which has been issued by the Chinese government, and this is dated October 9. It's going to come into effect from 8th of November next month, and this pertains to fresh restrictions that China is going to impose on certain material that is used in making lithium-ion batteries, anodes, and cathodes as well. So this would impact the EV manufacturing supply chain, because wherever we may be importing our batteries from or cells from, these kind of materials are used in all of that equipment. On top of that, what we also understand from our industry sources, we've been speaking to people in the industry to understand the impact, and they say that it's not just on the export of certain raw materials and more rare earth magnets, it is also on export of certain EV manufacturing technology as well. So this is where things get complicated. We've tried to understand what kind of rare earth magnets have been impacted. Well, they say that we were anyway not getting high rare earth magnets for the last few months. Now it's possible that medium rare earth magnets will also be impacted, and the industry understands here in India that at least 5 new categories of rare earths have been included in export controls. So we will really have to assess the impact over the next few weeks. But clearly, EV makers are likely to brace for more disruptions. These reports have reached the government. This issue has been widely reported around the world over the last 2 to 3 days. Indian industry bodies are concerned. They have reached out to the government saying these are new developments taking place. These are things that we need to be prepared for. A formal letter from the auto industry to the government may go in the next few days. They may seek a meeting seeking some sort of intervention to address this issue.
Okay, thank you very much for that. Just awaiting the WeWork listing. There you have it. The first tick will come up for you. The issue price was 648. The overall subscription was a muted 115%, in which the retail and the H&I category undersubscribed. The retail subscription was 61%, the H&I at 23%, and it's listed flat. 650 versus the issue price of 648. Amongst all the co-working flexible spaces which have listed recently, we have 4 of them now. Office, but that listed about 2 years back. But in the month of July, IndiCube and Smart Spaces listed, and SmartWorks, and SmartWorks is the one which has done very well since its listing, up 40%.
This was a pure OFS, right?
This was a pure offer for sale of 3,000 crore rupees, where the Virwani family, the promoters, and WeWork Global will be pairing part of their stake. And plus, there are certain ongoing investigations against the promoters, the Virwani family. And then there was this recent case, even in the Bombay High Court. So I guess all that has played. Margins for WeWork are higher than peers because it's a premium offering. But the utilization levels because of that is also slightly lower. But broadly, it's a loss-making company at the bottom line. So some reasons why, I think WeWork, investors took a bit of a cautious approach to WeWork. 632 now. Lower by 3%.
Okay, all right, that's a start, but a slightly subdued start. And we've had many of those, right? Not all of them are zooming up on day one, although many still are. Okay, lots of listings, lots of primary market action. Back to secondary markets, 80, 85 points on the Nifty. Sudeep Shah is with us with what he'd want you to do, Head of Technical and Derivatives Research at SBI Securities. Sudeep, good morning. A call on the Nifty first. We are basically, by the way, back above day before yesterday's high, which was 25,220, so charging ahead. Trades on the index, and we'll talk about stocks.
Good morning, Prashant. Prashant, absolutely. If you see the Nifty right now, above past 3 days swing highs now, all these while in the last 3 days, we have seen some selling pressure from that 25,200 to 20 mark. But from a market breadth perspective, this time around, we feel that the structure is really good because in the last 6 to 8 months, whenever Nifty has taken resistance around that 25,200, 300 mark and slid down, what we have seen is that the market breadth was not as good as it is this time around. So we feel that this time the markets are slated for a breakout, and on the downside now 25,100 becomes an important support. So till 25,100 holds, we are looking at 25,500, 25,600 on the Nifty in the coming 7 to 8 sessions. On the Bank Nifty, which has been stronger out of the 2 indices in the last several sessions, there we feel now it's a clean breakout. 55,800, 55,850 now becomes an important support, and Bank Nifty could head towards 57,300 and 57,700 in the coming few sessions. So we feel that both Nifty and Bank Nifty are slated for an up move with 25,100 support on Nifty and 55,700 supports on Bank Nifty.
Okay, what about any stocks?
Yeah, there are a couple of stocks now. One from the defense space. We've seen in the last couple of days, once again, defense has seen some kind of action and accumulation has happening even at higher levels. Now, case in point, BEL, Bharat Electronics Limited. Here we have seen a small breakout on the daily charts as well as on the weekly charts. The structure is quite strong. So this stock can be bought on dips with stop loss at 405 and targets at 425 and 435. The second stock is NBCC. Within this housing space, housing construction space, we have seen that last few days the stock was consolidating between 108 and 112, 113. Today there is a breakout, and this looks even good on the weekly as well as the monthly charts. A strong reversal is being observed. So we feel that from the current levels, plus and 120 as a target on the upside.
Got that. So, sorry, which is the last one, Sudeep?
NBCC. NBCC. This,
Okay.
yeah.
Okay, thank you very much for that. This NetWeb is zooming quite a bit, so that's up close to about 3.5%. About 8% of their revenues comes in from data centers, where they also provide not just the physical infrastructure, but they also provide a lot of cloud solutions, which go into the data center, and that's the stock which is up 3%. And the other one doing very well is Sona BLW, which has signed an MOU with a German company for manufacturing robots, humanoids, which go into on the factory floor. So that's a big mover, 4% up. Get into a break. Manisha joins in on the other side. Welcome back. As promised, let's talk commodities. Manisha is now joining in. Manisha, what are you looking at today?
Well, I'm looking at silver, absolutely, because this is an important week when it comes to silver, and you have various headlines coming in for silver as well. So in the international markets, we've made an all-time high, and this time around at 51.30. The last time we went closer to 50 was in 1980, then 2011. But this time around, there are a lot of factors in play which seem to be supporting the prices there. Having said that, if you look at the last 1 month, we've gained up by 19% for the silver prices. And in this year until now, we are up by 72%. This is the best yearly gain that you've seen in many, many years come in for silver there. If you look at the Indian prices, then MCX has seen high above 150,000. In the spot markets, adding to the premium because the physical silver has been in shortage. There have been talks about delayed delivery. So, and add the GST to that as well. So the spot prices saw an all-time high of 163,000 there, or 1,63,000 rupees a kg. Now talk about silver ETFs, and in last 24 hours, all we've been talking about is silver ETFs. Here you have ETFs from Nippon, HDFC, Kotak, UTI, Tata, etc. And when you look at the high NAV, that all-time high NAV that silver has hit on ETFs has been at 165. So it has been a huge premium that silver ETFs have been commanding over spot, over MCX as well. Why is this happening? Because there's a complete disconnect at this point in time from the physical market. The silver ETFs have worked anywhere between 2 to 10% as we've seen in the trade yesterday. Also, investors are paying higher than the actual price, and is the reason we have had Kotak come out and say that this is not what we want it to be, and they have pulled back from a lump sum amount that you have to pay onto that. Strong investment demand, expectation that the silver prices will go much higher from here are some of the factors that we've seen play on the markets there. Physical shortages is one part of it. And remember, when you are investing in an ETF, every unit of silver ETF has to be backed by actual silver, and that is shortage in the markets there, and that's the reason you're looking at a huge premium continuing into the markets. But if you are buying physical and ETFs at this point in time, remember that you're paying a premium which isn't aligned to the international markets, and so going forward, as and when these markets align, you have paid a higher premium there to buy these markets. Anyways, as I said, Kotak Mutual Fund is temporarily suspended lump sum or switch in subscriptions effective 10th of October until as and when they come out with the next notification there. So this does tell you that there is an issue when it comes to physical silver availability, and that seems to be disrupting markets across there. Silver prices have been gaining in the last 3 or 4 years, and we know that there is a deficit in the international markets. The buying has been strong. Investment, Indian buying at 5,000 to 6,000 tons a year also has been on a stronger side there. And there is shortage of freely available silver in the London market as well. This is where the prices are fixed, and this is where the international markets take cues in from as well. This is a 5th year of deficit. Markets are looking at very strong sentiment. There is this conversation about further US Fed rate cuts as well, lower real interest rates, and that seems to be supporting tangible commodities, is the reason you have seen gold, silver, for that matter, even Bitcoin do very, very well in the markets there. I want to talk about on the overall global silver availability, and as per the Silver Institute, you could be looking at a deficit of around 100 million ounces. That clearly has been supportive. Take a look at the Indian markets now in sense of prices, and this is a 5-year jump in card where you can see in 2016 we were trading at around 39,000. 2020, we were trading at 67,000 rupees a kg, and fast forward to 2025. So in 5 years, we've more than doubled when you look at silver prices. When you look at the prices in 2025 for the international markets, we started this year with $29.5 an ounce, and every few months, we've seen prices continue to gain up. 72% up from where we started. 51.3 is what we've done. And when you look at the global banks and brokerages, they are still talking about higher silver prices going forward from here. This is an interesting data. When you look at the cost of production for silver, it's anywhere between $8 to $26 an ounce. Remember, silver is a byproduct when you're taking out zinc and lead, etc. So then the cost isn't so much. So $8 to $10 to $12 when you're taking out silver. But $28, $26 is when you're taking out from a silver mine as well. So at $51 an ounce, you stand in very strong profits if you were a miner there. This is what we've done in last many years when it comes to silver price gains. So it has been a constant gain, but 72% is the best in last 15 years now. Going forward, Nomura says that the global markets will see a deficit of 142 million ounces, and they expect prices to make an average of $50 an ounce on the 4th quarter. Julius Baer, of course, is slightly more bullish. 52 to 58 is what they expect. Once 50 is done, they expect the prices to continue to gain up.
Okay, all right. Thanks very much, Manisha, for that exhaustive explanation. What's happening with precious metal silver in focus there. We'll take a quick commercial break here. We're going to come back with our special segment, Indianomics. Lata in conversation with Renuka Ramnath, the multiples, Srini Srinivasan of Kotak Alternate Asset Managers, and Rahul Saraf of Citi on whether if RBI's latest liberalization can lead to a huge rise in M&A activity. Remember, banks can now finance M&A. So there's a big move. Discussion follows in just a bit.
Welcome to Indianomics. The Reserve Bank is proposing to liberalize rules governing financing mergers and acquisitions. Currently, companies don't get bank loans, nor can they raise foreign loans to do acquisitions. These restrictions are going to end soon. Companies will soon be allowed to tap bank loans and foreign loans to finance acquisition, but there's more. Foreign loans can also be used to buy real estate, purchase and development. That's not allowed now. Also, banks can lend more against REITs, units of REITs and InvITs, and also without any limit, they can lend against debt securities, listed debt. Companies can also raise much short-term foreign loans. Originally, it was 5 to 10 years. Now, ECBs can be raised for 3 years. What's the impact of all these huge changes? Will there be a flood of M&As? especially in industries like, say, cement, textiles, where there's fragmented capacity? Will dollars flow into Indian real estate, make real estate expensive for Indians? And will dollars flow in per se? Today on Indianomics, I have three experts to discuss these. Renuka Ramnath, founder and CEO at Multiples, Srini Srinivasan, Managing Director at Kotak Alternative Asset Managers, and Rahul Saraf, India Head of Investment Banking at Citi. Gentlemen and Renuka, thank you very much indeed for your time. Renuka, starting with you, since you have spearheaded so many companies into the market, is there going to be a spate of M&As?
No, I would look at it as a reform which will have extremely positive long-term impact. Nothing can change overnight. What India needs is enormous debt coming in for the kind of growth that we have planned. CRISIL has estimated about 120 lakh crore debt that corporate India need in the next 5 to 7 years. So this reform will really play into that need extremely effectively. The other thing is that large corporates in India denied access to global capital on an even platform like their global peers, right? We are building companies here in India of global scale, global relevance, competing in the global market.
No, we could raise for raising capacity, but they could not raise to buy someone else's capacity.
Yeah, but ECB, there were other restrictions on the borrowing. It was not a level playing field. So I find the reform in the ECB guidelines extremely comprehensive. So it helps large corporates to get into a level playing field, and it helps small corporates to borrow now for M&A activity. Okay. Third, I think we should remember that in India, we had no mechanism to unlock the amount of value that is sitting in equity. Today, there is roughly $7 trillion by value between listed and unlisted put together of equity. We still have, India is a very fragmented market. You know, if you look at average market cap per company, we are at billion, and the next highest is China at 2 billion and US at 15 billion. Okay. So we are an extremely fragmented corporate, which brings with it a lot of inefficiency, and especially in the going forward global situation, these companies cannot compete and survive. So M&A consolidation is a must rather than a desire for us to go to that growth, keep the jobs, and move progressively rather than see a demise of a lot of companies around us. And I think this reform will definitely hugely facilitate it. So I expect to see the change over the next 2 to 3 years, because companies will have to make up their minds and look at consolidation as a serious value unlocking mechanism. But it is an excellent move. Any which direction you read this reform, it just exhilarates me and enhances the confidence of India achieving that 7 to 8% growth and becoming the third largest economy in the world.
No, certainly, huge financial muscle given to corporates, or at least, when the rules are finalized. Srini, your first thoughts on the ECB rules? But I also wanted to know about real estate. That was a sacred cow because, land becomes expensive for an Indian buyer. Do you see money rushing in? Because it's, I would think, a very lucrative business.
First of all, if you look at the entire package that RBI has put out for the banking industry as well as, M&A financing, the summary that you mentioned, I'm most excited about it. And as we were discussing just before the show, this is the 1992 moment for the credit markets in India. 1992 was when foreign investors were permitted into the equity markets.
It was the equity moment.
Right. And, within a couple of years thereafter, SEBI had actually come up with this, what we now know as free pricing of IPOs. Otherwise, a quaint little department called the Controller of Capital Issues used to decide at what price a company can do an IPO.
Yeah.
So in one stroke, RBI has opened up ECBs in terms of what is the end use that you can use it for, in terms of the pricing that you can, price it, it is linked to market conditions, and most importantly, in terms of who can actually provide ECB loans. If you look at the draft of what they have put out, it could be anybody who can provide an ECB loan.
Earlier, like it was my uncle living abroad can give it.
Exactly.
It says any resident abroad.
Any resident abroad can provide an ECB loan. So this is a great moment for ghar wapasi of all our dollars.
Okay. Yeah, especially since it shows more growth.
Absolutely. But what it also does for the banking industry, and I think As far as the banks are concerned in India, they've done two things. They have unleashed the banks in terms of the kind of reforms that they can operate as a conglomerate. And I think many banks which operate as conglomerates in multiple facets of financial services will find it so much easier to do business.
Yeah, overlapping rule restriction is gone.
That is one. Secondly, they've also, kindle the animal spirits of the banks which have an overseas presence, because the ECB regulation provide the overseas branches of banks also to participate in this whole financing market. So it's not just, you've opened up the credit markets for everybody else. You also have an opportunity to provide this credit. And if, as Renuka said, if M&A financing is going to be a big play and which grabbed the headlines, M&A financing can be done by domestic banks, both rupee and foreign currency. It is a very interesting play of, what could potentially play out with regard to the credit markets.
We don't know that BOB has one of the largest number of foreign branches.
Exactly.
I think, now it will be appreciated.
Yeah.
Rahul, your thoughts. First of all, you're also addressing dollar investors among our viewers. Is there, did you tap any of the foreign FPI in your conversations? Did you get a sense that money is waiting to come?
I think if we step back and say, okay, there are three types of M&A. You have inbound investments, so global guys coming and buying in India. Again, there's no change really that dollar was getting, that offshore financing was getting done. Then there was India outbound, where Indian corporates could borrow offshore as well. There was no restriction there.
Yeah.
I think the level playing field that Renuka talked about, where the Indian strategics now have the opportunity to tap the bank financing and do the acquisition. What were they doing earlier? They were taking private credit, NBFC financing, mutual fund financing. All of that was 100 to 200 to 250 basis points expensive. If you look at just from a corporate finance perspective, the math, it allows the Indian strategics to be at least 10 to 15% more competitive now compared to a foreign corporate or a private equity who was relying on offshore financing. So that's a big cushion.
Big gap that is...
that has got bridged, yes.
Okay.
So I think that's interesting. And then, of course, the end-use restrictions on ECB, I think that allows both the tenor as well as the end-use, allows more diversity in terms of financing options. So all in all, very welcome.
You expect dollars to come in?
Expect dollars to come in for sure, 100%. Yes.
Okay, but before I take my first break, something which stock market investors will want to know, where will consolidation come first? Do you see it in, say, paints, cement, textiles? What is the first thought that comes to the mind?
I would say manufacturing, definitely. And I think family-owned businesses. We see a lot of activity in families wanting to kind of move forward by leaving the businesses either with private equity owners or strategics.
And we're already seeing that, right?
We are seeing, the recent transaction multiples did. VIP Industries is, standout example being a listed company.
Okay.
So there will be, I think, wherever there is family-owned business, right? This fragmented ownership, dilution issues for family, changing their mental framework from being a controlling shareholder to a minority shareholder because you want to be a large conglomerate. All of that is going to be very complicated. I think the right method they would see as working well for them and markets would be to consolidate.
Fair enough. Okay, so there are some equity ideas also coming over here. Banks with foreign branches are going to be at an advantage. As well, fragmented industries are going to see a great deal of consolidation. For those of you who want to do the equity math, that's the clue. We have to take a quick break. We'll continue our conversation with our experts. For Bazaar viewers, it will be Chartbusters. You will get to hear the whole show after Market Hours.